Let's talk about bankruptcy as an alternative. Again, I always tell people that bankruptcy is something you should look at just so that you have it in your list of options. It's especially going to be helpful if you're concerned about the tax hits that we're talking about. You're going to be concerned if you have other debt that you can't pay. I've had people that are drowning, they have $20, $30, $40, $50,000 in credit card debt, and they can't pay the credit cards and pay the mortgage. Well, if you can eliminate that credit card debt, you might make it easier to save the house, pay the mortgage, pay other expenses. So this may be where it's very helpful. Again, bankruptcy is not right for everybody, but for a lot of people, it can be a lifesaver. And again, as I tell people, the goal here is not necessarily to pay your creditors first, but to pay what you can afford, if you can, and to preserve your ability to continue to be income producing, supporting your family, and protecting your family. Filing a bankruptcy, of course, stops all your collection efforts. It stops foreclosures and auto repossessions if you happen to be behind, but that's only temporary in most cases if you're doing a Chapter 7 bankruptcy. In a bankruptcy, mortgages and car loans continue through the bankruptcy, so you're not going to stop a foreclosure simply by filing a Chapter 7 bankruptcy. We'll talk more about that in a minute. You're going to have to pay, certain debts won't be discharged in bankruptcy. You can discharge most debts, but you won't discharge student loans, and you won't discharge most income taxes, sales taxes. Again, this is all part of what you have to look at. Here's the surprising question. If you're in financial difficulty, if you file bankruptcy, as opposed to not filing bankruptcy, who ends up better off? The New York Federal Reserve, the Federal Reserve Bank of New York in February of 2015 did a study. They did a detailed study comparing a whole bunch of things, but they looked at what happened to they looked at households that were in financial difficulty, that were insolvent, and they looked at those who filed bankruptcy and those that didn't file bankruptcy. Here's what they found. They looked at a period of what happened within a year to a year and a half later. The individuals who do go bankrupt opened a larger number of new unsecured accounts and had greater access to credit a year and a half later than the people that didn't. It's not hard to figure out why. People that are drowning in debt are simply, they're just simply sitting here, and maybe they're being sued. They're not in a position, they're not credit worthy. People that file bankruptcy may have eliminated a bunch of debt, and now they're more credit worthy because they don't have a whole bunch of, they're not drowning in debt. It's ironic, but because after you file a bankruptcy, you can't get another bankruptcy discharge for 4 to 8 years, you're actually a prime candidate for, say, credit cards or other high-interest loans. So this doesn't surprise me. But what's interesting is that this study validates what I've always thought was the case. The study found that at first, those who do file bankruptcy have lower credit scores than those who don't. Again, because they are now a high default risk, relatively speaking. But a year and a half later, the individuals who go bankrupt experience a sharp boost in their credit score after bankruptcy, whereas the recovery in credit score is much lower for individuals who don't go bankrupt. That is really astonishing. I'm not suggesting you should file bankruptcy if you can avoid it, but if you're drowning in debt, and again, a bankruptcy might be the way of dealing with this. Let's talk about the basic bankruptcy, which is Chapter 7. In a Chapter 7 bankruptcy, like any bankruptcy, it stops all creditors from any effort to collect from you. Instead, your creditors have to collect through the bankruptcy process. And in that process, two things happen. First, a bankruptcy trustee is appointed. This is a person appointed by the Department of Justice from a pre-qualified panel of people. And the trustee's job is to look at what you own to see if you have anything that can be sold or collected, or there's other ways to get money paid for creditors, to pay creditors. As part of your fresh start, you get to claim certain types and amounts of property as exempt, and this is what you get to keep. I won't go into the details of the exemptions, but typically when I analyze things with people, that's what we're looking at, is seeing, can you exempt everything? There are some fairly liberal exemptions. Not everybody is completely protected, but you'd be surprised at how much property that you can protect. And again, that means if you're able to exempt it, the trustee is not going to sell it. And in many of these cases, we have a situation where there's nothing for creditors. Sometimes there is, but that's the basic process. That doesn't end the matter. If there are assets, for example, like let's assume that you had a house with $50,000 in equity, it might get sold. You get your portion, let's assume it's $30,000, that's just a number I'm using, and the rest goes to pay the creditors. There might be other things like that. But in order to do Chapter 7, you have to qualify. The first thing, of course, is we look at your budget. Do you have disposable income? You can't do a Chapter 7 say, I'm not going to pay anything to creditors if you have the ability to pay something to your creditors. If your budget shows that you have $400, $500, $600 a month in disposable income that you can pay to creditors, you're going to be in Chapter 13 paying what you can afford over a period of 3 to 5 years. Again, the rules are complicated. I'm summarizing. Again, it all depends on the circumstances. You also have to pass something called the means test. What the means test says is first we're going to look at your gross income for the last 6 months, not the net pay, the gross pay. So we look at the gross income from paychecks, from maybe money coming in on pensions. We don't count Social Security. And we compare that dollar number to what's called the median income in New Jersey. The median income is, if you're a household of 4 people, for example, the point at which half the households earn more, half the households earn less. If you're above that number, then they apply the means test. The means test is a complicated formula. Basically, it's the same formula that the IRS uses when they figure out how much you can afford to pay in taxes. For many people, the means test can be a major problem if you don't qualify. But that's the issue you have to look at. Again, this is something that requires careful analysis. You don't get a bankruptcy discharge in Chapter 7 if you've previously filed a bankruptcy and got a discharge in Chapter 7 within 8 years, or you did a Chapter 13 within 4 years. If you have a car loan and you want to keep the car, you're going to have to be current on the car, stay current on the car loan, and you're going to have to sign a new promise to pay called the reaffirmation agreement. That agreement basically takes that car loan out of bankruptcy and becomes non-dischargeable. It's a very important decision because that means that if later on after your bankruptcy you can't make the car payment, they repossess it, they can and they will sue you personally for the money owed. It makes that debt non-dischargeable, but that's the price you pay for keeping the car. For some people, we urge them, if you can't afford a car, it's a high interest loan, give it up. Let them have the car back and do without it. Again, that's a tough decision because for most people the car is the single most important thing they have. But sometimes people have gotten in situations where they have bought a car they couldn't afford. And rather than continuing with that, one of the things you can do is simply eliminate that debt. Normally you wouldn't do that outside of bankruptcy. You wouldn't simply turn in the car because they'll sue you personally and try to collect the money from you. But bankruptcy stops that. If you're behind on the mortgage, the bankruptcy will slow down but won't stop a foreclosure. Mortgage debts continue through the bankruptcy unimpeded. Chapter 13 is a different animal, but it's related to Chapter 7. Chapter 13 is for people that have regular income of some kind and they have the ability to pay something to their creditors. A confirmed Chapter 13 plan. What you do in Chapter 13 is you propose a plan that's going to pay your creditors what you can afford over a period of 3 to 5 years, depending on your income situation. If you're behind on a mortgage, you can use a Chapter 13 bankruptcy plan to bring the mortgage current over 3 to 5 years, pretty much without interest. If you owe IRS or other back taxes, for the most part, you're going to have to pay those in full over the life of the plan. One of the other hidden benefits, sometimes we have people that have high interest car loans. They went out and they got a car loan, it's 12%. Well, in a Chapter 13 bankruptcy, you can cut that rate on that loan down to maybe 4 or 5%. You have to pay it off over the life of the plan, but that could be a big benefit. So Chapter 13 may work for many people. There's a lot of other opportunities and possibilities. Chapter 13, again, requires a careful technical analysis, but this gives you some idea of what it might do. What are the keys to being successful in Chapter 13? Well, careful planning, budgeting, paying attention to the details. The hardest thing for most people in Chapter 13 isn't getting into it, it's staying in it. I tell people when you do that budget, you have to live within that budget. If your budget says you're going to live on $3,000 a month, that's what you have to live on. And what happens is people forget that, that you got to put aside $300 a month for car repairs, medical expenses, and they're not doing that. But if you do that, this can be a great way to recover, to again get a situation under control. The other big advantage is that essentially in a Chapter 13, you're paying your creditors what you can afford. Maybe you're in a situation where you can't pay the $70,000 in credit card debt in full, but you can pay maybe half of it. The nice thing about this is Chapter 13 gives you a guaranteed way of paying what you can afford, and all you have to do is make those payments. At the end of the day, the creditors have gotten what you can afford, and you've gotten a discharge of whatever's left with no tax consequences. In a Chapter 13, you have to pay your unsecured creditors at least what they would have gotten in a Chapter 7 if your assets had been liquidated. You have to pay substantially all your disposable income for 3 to 5 years. You have to apply a variation of the means test that says here's the minimum you have to pay your unsecured creditors. Again, this can be a major problem for people, but this is something you have to explore, and earlier rather than later. Very often we get people that missed an opportunity to use bankruptcy at a point when it might have worked, and now